Welcome back to another deep dive. Today, we're going to be talking about consumer staples stocks.
Okay.
Those everyday necessities that people keep buying,
Right.
no matter what the economy is doing.
Yeah.
We're going to try to figure out if any of these stocks might be worth your attention
Okay.
for the rest of 2024.
Interesting.
So our guide for this deep dive is going to be an article from the Motley Fool
Okay.
by Ruben Greg Brewer.
Sounds good.
It was published pretty recently, actually,
Okay.
November 22nd.
All right.
So very timely.
Yeah.
And Brewer really focuses on three specific companies in this article.
Interesting.
And I think one of the things that I found most interesting is he actually calls himself a cheapskate
Oh, really?
when it comes to investing.
That's interesting.
Yeah.
So you think he's maybe looking for bargains?
That's what makes me think he
Yeah.
calls them fallen angels.
Fallen angels.
Yeah. So good companies that are facing temporary problems.
Oh, so kind of like classic value investing.
That's what it sounds like to me. Yeah.
Okay.
Trying to find value where other people are panicking.
Right.
But the trick is figuring out if those problems really are temporary.
Yeah. Are they temporary or are they signs of
Are they
something?
serious?
Yeah.
Exactly.
Okay.
So the first company he picks is PepsiCo,
PepsiCo.
ticker symbol PEP.
Okay.
And the article points out that PepsiCo's dividend yield is near its highest point in 40 years.
Oh, wow.
So
That's pretty significant.
that's what I thought too.
Yeah, that could definitely mean that the market is undervaluing the stock.
Right.
But of course, we're going to have to look
Yeah.
deeper than that.
Exactly.
We're going to have to consider the payout ratio
Right.
and compare it to historical trends, factor in their future earnings potential,
Okay.
all that stuff.
Yeah. So not just looking at that high yield and being like,
Right, exactly. Not just looking at that number in isolation.
oh, we're going to buy it,
Yeah,
but really making sure it's sustainable.
absolutely.
Right. And you can't forget that PepsiCo is not, some tiny struggling brand.
Right.
They're the #2 non-alcoholic beverage company globally.
Wow.
They own Frito-Lay,
Right.
which is the top salty snack brand.
So they've got snacks too.
And they have Quaker Oats.
And breakfast.
Yeah. So we're talking
Very diversified portfolio.
very diverse. Yeah. Wide moat, as they say in investing.
Yeah, absolutely.
But even giants face challenges,
Of course.
right?
Yeah.
And the article mentions a couple of potential headwinds for PepsiCo.
Okay.
The first one is the potential for increased regulation
Okay.
in the U.S. market,
All right.
and then also a slowdown in growth recently.
Okay.
So we've got the high dividend yield,
Right.
which looks like an opportunity,
It could be.
but then we also have these challenges that could be cause for concern.
Yeah, we're going to have to weigh those.
What do you think?
Yeah.
Do those challenges seem temporary to you, or signs of something more serious?
Well, the regulatory landscape is always shifting.
Especially for a company like PepsiCo. I mean,
Right.
we've already seen some cities and states implementing those taxes on sugary drinks.
Sure.
And there's a lot of concern right now about the environmental impact
Yeah.
of all the plastic packaging.
Uh-huh.
So if these trends continue,
Yeah.
it could have a real impact on their business.
That's a really good point.
Yeah.
I mean, it's not just about what the regulations are now, but what they could be
Right.
in the
what counts for it,
future.
Yeah.
Yeah. Yeah, think ahead.
And what about the slowdown in growth?
Well,
Is that something specific to PepsiCo, or is that...
I think the beverage industry as a whole has
Yeah.
been struggling with
Ah.
changing consumer preferences.
Okay.
People are increasingly choosing healthier options,
Mm-hmm.
and that's putting pressure on traditional soda sales.
Right.
So PepsiCo is definitely trying to adapt
Okay.
by expanding into those healthier beverages
Right.
and snacks.
Sure.
But we're going to have to wait and see how successful those efforts will be.
Okay, so it sounds like they are facing some
Right.
legitimate challenges.
Sure. Well,
But
yeah.
as you said, they're not just standing still.
Right.
They're trying to evolve and change.
Exact.
So the next fallen angel on Brewer's list is Hormel Foods,
Hormel.
ticker symbol HRL.
Okay.
And get this, Brewer actually already owns this stock.
Oh, wow. So he's putting his money where his mouth is.
Yeah, he really believes in it.
I like that.
And like PepsiCo Hormel is a dividend king,
Okay.
meaning that they've been raising their dividends steadily
Uh-huh.
for over 50 years.
Wow.
That's a long time.
That is really impressive.
Yeah.
Shows a strong financial foundation
Yeah.
and a real commitment to returning value to shareholders.
Right.
And their dividend yield is almost at an all-time high.
Wow.
3.8%.
So
Really makes you wonder if maybe the market is missing something.
it really does.
Yeah.
But there's a reason why that stock price is down.
Of course. Yeah.
And Brewer's not hiding that at all.
Okay.
He points out that Hormel is facing a triple whammy
That triple whammy.
of problem.
Oh, no.
So first of all, they're having trouble raising prices
Oh,
to keep up with rising costs.
all right.
Their recovery in China,
Huh.
which is a big market for them,
Right.
is moving slower than they expected.
Okay.
And there's a weakness in the nut snack segment,
Oh, interesting.
which is interesting because they recently bought Planters Peanuts.
Right. Yeah, I remember that.
So
That's a lot to juggle.
Yeah.
Even for a big company like Hormel.
it is.
Yeah. So are these problems insurmountable?
That's a question.
Or is the market overreacting?
Right.
Got to look at each of those issues
Right.
carefully.
Exactly.
For example, the difficulty with raising prices.
Yeah.
Are consumers pushing back?
Yeah.
Are retailers pushing back?
Right.
Or are their input costs just rising too fast?
Yeah.
You know, this is where it will be helpful to look at their financials,
Okay.
especially their profit margins.
Yeah, we need to understand the why behind it.
Right. Exactly.
And same with the slow recovery in China.
Yeah.
Is that a Hormel-specific issue
Mm-hmm.
or other companies in the food industry
Right. Are
and also struggling in China?
facing the same problems.
Right. We need the context.
Yeah.
And then the weakness in the nut snack segment.
Right.
Makes me wonder about the Planters acquisition.
Yeah. Was that a mistake?
Was it a mistake or is it just taking longer
Yeah.
than they expected?
Work out.
Right.
Yeah.
Is this a deeper problem?
Right.
Their growth strategy.
Or just a temporary setback?
Yeah.
Yeah. A lot to consider.
Lots to think about.
And to really assess their potential. You have to compare their financials.
Okay.
You know, their growth rates and their margins and their valuations,
Uh-huh.
not just to their own historical performance,
Okay.
but to other companies in the packaged food space.
Gotcha.
So how do they stack up against the other major players?
That's a good point.
Yeah.
Okay, so we've got PepsiCo
Right?
facing regulatory and growth challenges,
Yeah.
and we've got Hormel dealing with these pricing pressures,
Mhm.
the slow recovery in China, and that questionable acquisition.
Lots going on.
Are you ready for the last company on Brewer's list?
I am. I'm ready to dive into some chocolate.
Okay, because Brewer seems particularly excited about Hershey,
Hershey's?
ticker symbol HSY. He loves their dividend growth,
Right.
which has averaged 10% per year
Wow.
over the last decade.
That is impressive.
Yeah.
And look at that dividend yield, around 3.2%.
Hinting at a potential bargain.
Right. Another one.
Yeah.
But of course, we can't just jump in.
Yeah, we can't just jump
We're
in.
looking deeper.
We got to do our homework.
Why is the stock price down?
Right.
What makes them a fallen angel?
Exactly.
So they're facing skyrocketing cocoa prices.
Oh, wow.
And this isn't just normal inflation.
Okay.
This is like a serious supply issue.
That's impacting their bottom line.
That makes sense.
Yeah.
Cocoa is their core ingredient.
Right.
So if the price goes way up,
Mm.
it's really going to hurt their profits.
Yeah.
So we got to see how they're managing this.
Okay.
Have they tried to raise prices,
Hmm.
you know, pass those costs on to consumers?
Yeah.
Or are they just absorbing the blow,
Right.
which would really hurt their margins?
The article did say they've tried to raise prices,
Okay.
but you're right. There's a limit
Yeah.
how much people will pay,
Of course.
even for Hershey's chocolate.
Right.
So it's a tough situation for them.
Yeah, they need to protect their margins,
Right.
but they can't alienate their customers.
Like a mad.
Yeah.
Right.
But here's something I found interesting.
Okay.
Hershey's is also trying to get into the salty snack
Oh, wow.
and non-chocolate candy categories.
Interesting.
So it seems like they're really trying to diversify,
Makes sense.
which could be a good move,
Yeah.
especially right now.
So reduce their dependence on cocoa
Right.
and maybe offset some of that risk
Yeah.
from those price swings.
Exactly. And they could tap into some new markets
Okay.
with different growth dynamic.
I see your point.
Yeah.
So even though they're dealing with this huge cocoa price issue,
Yeah.
they're not just sitting back and taking it.
Yeah.
They're trying to find ways to adapt
They're looking for solutions.
and maybe even turn it into an advantage.
Exactly. And that's what we want to see
Yeah.
in a fallen angel.
Right.
Not just a company facing problems,
Mhm.
but a company with a vision
Right.
and the ability to actually solve those problems.
And come out stronger.
Yeah.
Exactly.
Right.
So we've got these three companies,
Yeah.
PepsiCo, Hormel, and Hershey,
Uh-huh.
all industry giants,
Right.
all facing some big challenges,
Definitely.
but all trying to find ways to overcome those
Now
hurdles.
it's to be a good deep dive.
Yeah, I'm excited to see where it goes.
Thank you.
But we've only just scratched the surface. When we come back,
Yeah.
we'll delve deeper into their financials, their growth prospects, and the competitive landscapes
Okay.
to really see if these fallen angels can rise again.
All right.
Stay tuned.
I'm ready.
Yeah, me too.
Welcome back.
So we've got these 3 potential fallen angels on our radar.
We do.
PepsiCo, Hormel Foods, and Hershey.
Yeah,
Big names, all facing their own unique challenges.
definitely.
But before we go all in on any of them,
Right.
it's important to remember that this whole fallen angel approach
Yeah,
comes with risks.
absolutely.
What could go wrong with this strategy?
Well, I think the biggest risk is that we misjudge those challenges.
Okay.
What if those headwinds
Yeah.
are stronger than we thought? Or they last longer?
Okay.
What if it's not just a temporary bump in the road? What if it's a fundamental shift in consumer behavior or the industry?
So we could end up buying into a company that's actually on a downward spiral,
Exactly.
not just temporarily out of favor.
Yeah, and even if the company does recover,
Right.
it could take a long time.
Okay.
You know, your investment capital could be tied up for years.
And those juicy dividend yields,
Right.
they're not guaranteed,
No, they're not.
right? If the company's finances get worse,
Yeah,
they might have to cut the dividend
absolutely.
or eliminate it completely,
Oh.
which would be bad news for investors.
Especially if you're looking for income.
Exactly.
Yeah.
So it's not a risk-free strategy.
Right, it's not.
We got to be realistic.
For sure.
But let's say we've done our research.
Okay.
We're confident that a particular fallen angel can rebound.
Yeah.
What should we be looking for?
Well, first of all, you got to understand their debt levels.
Okay.
How much debt are they carrying?
Uh-huh.
What are the interest rates on that debt?
Right.
And how does that compare to other companies in their industry?
Okay.
Because a high level of debt can really make things difficult,
Sure.
especially when interest rates are rising.
Yeah, it's like having a heavy backpack while you're trying to climb a mountain.
Exactly.
Makes the journey a lot harder.
It does, yeah. And speaking of mountains,
Okay.
you got to look at their cash flow.
Okay.
Are they generating enough cash to cover their expenses,
Uh-huh.
pay down their debt,
Right.
and invest in future growth?
Okay.
So positive and consistent cash flow,
Yeah.
that's a sign of a healthy business.
Makes sense.
And it's especially important
Okay.
for companies that are facing challenges.
So it's not just about how much money they're bringing in.
Right.
It's how well they're managing it.
Exactly.
What about their return on equity?
Yeah, ROE is another key metric.
Okay.
Tells you how efficiently they're using shareholders' money
Uh-huh.
to make a profit.
Okay.
So generally, a high ROE is a good sign.
Makes sense.
It means the company is creating value for its investors.
So we're looking for a company that can not only survive these challenges,
Right.
but come out stronger,
Exactly.
more profitable.
Yeah.
You want them to thrive.
Now, you mentioned earlier
Yeah.
that all 3 of these companies
Mm.
rely heavily on consumer spending,
They do.
particularly in the U.S.
Right.
So that makes them vulnerable to macroeconomic risks,
It does.
like a recession.
A recession would definitely be a concern.
So,
Well, during an economic downturn,
yeah.
people cut back on spending,
Okay.
especially discretionary spending.
Right.
And even though we think of consumer staples as essential,
Mm-hmm.
there's always a limit to how much people are willing to spend.
So even these recession-proof companies
Yeah.
could see a drop in sales
It's possible.
if the economy weakens.
They might not be hit as hard as some other companies.
Okay.
But they're not completely immune.
What about inflation?
Inflation is another tricky one.
Okay.
It's kind of a double-edged sword.
I would think that rising prices would actually benefit these companies.
You would think so, right?
Yeah.
Because they're selling essential goods.
Yeah. But it's not that simple.
Okay.
On the one hand,
Yeah.
it does give them an opportunity to raise prices
Uh-huh.
and maybe boost their revenue.
Right.
But on the other hand,
Okay.
it can also squeeze their profit margins.
How so?
Well, if their input costs are rising faster
Okay.
than they can raise prices,
I see.
then they're in trouble.
So it's a balancing act.
It is.
They got to protect their profits,
Yeah,
but not make customers angry.
right. You don't want to price them out.
And if inflation keeps going up for too long,
Yeah.
people might just get tired of it.
It's called consumer fatigue.
Okay.
They just can't afford to keep up,
Even with essentials.
even with the basics.
Wow.
So it's a reminder that even these companies,
Yeah.
they're not immune to the bigger economic trends.
Right. We got to keep an eye on the big picture
We do?
as well as the company-specific details.
Absolutely. And don't forget about competition.
Oh, right. Competition.
This industry is always changing.
Yeah.
New companies popping up, new products.
Mm-hmm.
So these established players are always being challenged.
So we need to know
Yeah.
if these companies are responding
Are they innovating?
to these competitive pressures.
Are they adapting?
Right. Are they keeping their market share?
Right.
Are they investing in new stuff?
Are they keeping up with consumer preferences?
Right. Or are they just sitting back and resting on their laurels?
That's the question.
Okay. So we've talked about the risks,
Yeah.
the broader economic factors, the competitive landscape.
Right.
Let's go back to the specific challenges
Okay.
facing each company.
Sounds good.
We already talked about them,
Yeah.
but let's dig a little deeper.
Okay.
See if we can find any red flags or green lights.
All right.
What stood out to you as the most concerning issue for PepsiCo?
I think the potential for increased regulation
Okay.
in the U.S. market,
Yeah.
that's a big one.
Especially with all the concern about sugary drinks.
Right.
We've already seen some cities and states
Yeah.
implement taxes or restrictions.
Like the soda tax in Philadelphia.
Yeah.
That was pretty controversial.
It was, and if more places follow suit,
Yeah.
that could have a big impact on PepsiCo's sales.
Especially since their main product
Right.
is Pepsi.
It's a sugary drink.
Exactly.
So it's not just about the current regulations,
Right.
but what they could become in the future.
That's the worry.
Yeah.
Upset.
Or that raises some red flags for me.
Yeah.
They need to be proactive.
Yeah, they got to address those concerns.
Show that they're committed to sustainability
Absolutely.
if they want to keep customers happy
Right.
and avoid more scrutiny from regulators.
You got to show they're serious about it.
Okay, let's shift to Hormel Foods.
Okay.
They're facing that triple whammy,
Right.
difficulty raising prices,
Yeah.
slow recovery in China,
Mm-hmm.
weakness in the nut snack segment.
Lots going on.
Which one worries you the most?
I think the slow recovery in China is a big one.
Okay, why?
China's a huge market for them.
All right.
And their sales there have really suffered
From the pandemic,
from the pandemic,
the economic slowdown,
the whole thing.
and
Yeah,
China's economic outlook
right.
still uncertain.
Very uncertain.
There's talk of a property bubble,
Yeah.
rising debt.
Slowing consumer spending.
It's a lot.
It is.
So all that could weigh on Hormel's performance.
Yeah, for a while.
It's not just about waiting for the pandemic recovery.
Right.
It's about navigating a really complex situation.
With a whole new landscape.
So they need a solid plan.
They do.
What about the other two challenges?
Yeah.
Raising prices and the nut snack weakness.
Well, the pricing issue
Yeah.
is a bit concerning.
Okay.
Suggests they might not have as much pricing power as we thought
Uh-huh.
if they can't pass on those costs.
Yeah. To consumers.
Their margins could suffer.
Oh.
Profits could take a hit.
And the Planters acquisition.
Right.
That was supposed to be a growth driver.
It was.
But now that segment is weak. Makes you wonder if they can even make smart acquisitions.
It does.
Integrate them effectively.
It raises some questions.
Yeah.
Maybe the nut snack market is just more competitive.
Okay.
Or maybe they overpaid.
For Planters.
Yeah.
Or maybe they're just having integration problems.
Could be.
Whatever it is, it's not good.
Not a good sign.
Okay, so Hormel's facing some serious challenges,
They are.
internally and externally.
That's sure.
Let's move on to Hershey's.
Okay.
Those cocoa prices.
You're right.
How big of a problem is that, really?
It's a significant challenge.
Okay.
I mean, cocoa is key for them.
Right.
And when the price goes up like that,
Yeah.
it can really hurt their margins.
They've tried to raise prices,
They have.
but there's a limit
There is.
before customers start pushing back.
Yeah, they can't price themselves out of the market.
Right. Especially with all the competition
Exactly.
in chocolate.
Yeah, and it's important to remember
Okay.
that Hershey's is at the mercy of a lot of factors.
Like what?
Weather patterns, political instability in cocoa-producing regions, even disease outbreaks that can affect the crops.
So it's a risk that's hard to control,
It is.
even with the best management team.
You're at the mercy of the cocoa gods.
What about their strategy of expanding
Yeah.
into salty snacks and non-chocolate candies?
That could be a good move.
How so?
Diversify their products.
Okay.
Reduce their reliance on cocoa.
Makes sense.
But it's not a sure thing.
Right.
They're going up against some big players.
In those markets.
Yeah.
So no easy answers.
Not really.
Even with something as simple as chocolate.
Right.
There are all these complex factors
It's complicated.
that can make or break a company.
That's the reality of investing.
Yeah.
It's all about uncertainty,
Yeah.
weighing the risks and the rewards,
Right.
making decisions based on the best information you have.
Okay, so we've taken a closer look
We have.
at the specific challenges
Yeah.
for each company.
Uh-huh.
None of them are without risk, but we've also seen some glimmers of hope.
We have.
PepsiCo's commitment to innovation,
Right.
Hormel's track record of profitability,
Uh-huh.
Hershey's iconic brand, and their efforts to diversify.
Yeah.
Do those glimmers of hope outweigh the red flags?
That's the question.
When we come back, we'll delve into their financials,
Okay.
their growth prospects,
Uh-huh.
and the competitive landscapes
Sounds good.
to see if these fallen angels really can rise again.
I'm ready.
Stay tuned. Welcome back. We've spent a lot of time unpacking this whole fallen angel concept and dissecting the challenges facing PepsiCo, Hormel Foods, and Hershey. Now it's time to roll up our sleeves and really dig into their financials and see if these companies have the strength to rise again.
All right, let's crack open those financial statements and see what story the numbers tell us. We're looking for signs of resilience, smart management, and the potential for future growth, of course.
Okay, so let's start with PepsiCo. Anything in their financials that's screaming red flag or waving a green light?
Well, their revenue growth has been a little, lackluster lately, like we talked about earlier. But their global reach, their diverse product portfolio, they're a cash-generating machine. Beverages, snacks, breakfast foods, that creates a solid foundation for stability, I'd say.
Okay, so maybe not setting growth records, but still bringing in the big bucks.
Mm-hmm.
That is reassuring. But what about their profitability? Are those rising costs eating into their margins?
To really understand that, we need to look at their operating profit margin. That tells us how much profit they're making from each dollar of sales after we account for their operating expenses. And for PepsiCo, that margin has been pretty steady, hovering around 15%.
15%. Is that good?
It's actually quite healthy for a company in the consumer staples sector.
So they're managing to keep those costs under control, keep a decent profit margin, even with all the inflation and supply chain craziness going on. That's a good sign. What else should we be looking at in their financials?
We talked about their debt levels earlier. Debt is just part of life for a company like PepsiCo, big acquisitions, global operations. The key is making sure they're managing that debt responsibly. Right now, their debt-to-equity ratio is around 2.5.
2.5, that sounds kind of high, no?
Well, it's actually in line with their historical average and pretty comparable to other big players in the industry.
Okay, so not drowning in debt. That's good. But what about their ability to actually generate cash flow? We talked about how important that is, especially for companies facing challenges.
You're right. Cash flow is king. And PepsiCo is doing well on that front. Their free cash flow, the cash they have left over after all the expenses and investments, it's consistently strong, around $7 billion a year.
Wow. Okay, so they have some flexibility.
Yeah, plenty of room to keep investing in growth, paying those dividends, even buying back their own stock if they want.
All right, so financially, PepsiCo seems to be on pretty solid ground. Maybe not the most exciting growth story, but solid. Let's move on to Hormel Foods. What's their financial picture look like?
Well, Hormel is definitely facing some margin pressure, no doubt. Those rising input costs are taking a bite. Their gross profit margin, that's the profit they make on each dollar of sales before we factor in operating expenses, it's been shrinking a bit.
That's a little concerning.
It is something to watch. But on the plus side, their balance sheet is strong, and they've got a long history of managing those costs really well.
Okay, so not in a financial crisis, but those rising costs are a yellow flag for sure. What about their debt and cash flow? Any good news there?
Actually, their debt-to-equity ratio is quite low, around 0.4.
So they're not using much debt at all?
Nope. Gives them a lot of flexibility and makes them more resilient if things get tough. And their free cash flow, while not as massive as PepsiCo's, has been consistently positive, averaging around $1 billion a year.
$1 billion. Not too shabby. What about the return on equity, that ROE we talked about? Are they using their shareholders' money well?
Their ROE has been hovering around 15%, which is pretty respectable, especially for the packaged food industry. So yes, they're generating a good return on those investments and creating value for their shareholders.
All right, last but not least, let's take a look at Hershey. How are they holding up financially, considering those cocoa prices are through the roof?
Well, there's no way to sugarcoat it. Hershey's profitability has taken a hit because of those cocoa prices. Their gross profit margin has definitely shrunk. That's a red flag.
Yeah, tough situation.
But they're still generating positive free cash flow, and that brand loyalty they have, that's a powerful asset.
It's true. There's just something about a Hershey's Kiss. No one else does it quite like that. But seriously, that kind of brand loyalty gives them some pricing power. Does that show up in their financials?
It does. Their operating profit margin, although down a bit, is still pretty healthy, around 17%. So they've been able to raise prices a bit, pass on some of those costs to customers without losing too many sales.
Okay, that's good to hear. What about their debt and cash flow? Any warning signs there?
Well, their debt-to-equity ratio is a bit higher than Hormel's, around 1.2, but still manageable. And their free cash flow has stayed positive, averaging around $1.5 billion annually.
So they're not strapped for cash.
Nope. They have the resources to invest in growth, pay their dividends, and ride out this cocoa price storm.
All right, so financially, all three companies seem to be in decent shape, even with those challenges. But what about their future? Are they positioned for growth, or are they stuck in these mature, slow-growing markets?
That's the big question, isn't it? Let's start with PepsiCo. They're really pushing into those healthier snacks and beverages, trying to capture those changing consumer preferences. They're also expanding into emerging markets with more growth potential.
Smart moves. Adapting to what people want and looking for new opportunities. But are they actually seeing results from those efforts?
Their revenue growth in those segments has been pretty good, actually, better than their overall growth rate. It's still early, but it looks like they're on the right track.
Okay, potential for growth there, but it might take some time. What about Hormel Foods? Are they just sticking with those traditional meat products, or are they trying to innovate and stay ahead of the game?
They're definitely not just sitting back. They're focusing on innovation, trying out new products and flavors to keep things fresh and exciting. They're even looking into plant-based protein options, to tap into that growing demand for meat alternatives.
So they're not just a meat company anymore.
Not exactly. They're becoming more of a broad food company. That could open up a lot of new possibilities.
I like it. Adapting to change.
And don't forget about the Planters acquisition. Yeah, it's facing some hurdles now, but it could still pay off if they can integrate the brand well and really leverage their distribution network.
Okay, so potential, but some uncertainty with Hormel. What about Hershey? Just relying on those classic chocolate bars, or are they trying to grow and evolve too?
They're actually branching out into salty snacks and non-chocolate candies like we talked about. And they're also getting into e-commerce, those direct-to-consumer channels, to reach people where they are.
So they're not just crossing their fingers and hoping for the best.
Nope. They're trying to diversify their revenue and keep up with how people shop these days.
Smart. But can they really compete in those new markets?
We'll have to see. There are some tough competitors out there, big companies with established brands, but Hershey's got that iconic brand, that distribution network, and they know how to market to consumers. So we'll see.
So no guarantees for any of these companies, but they're making strategic moves to set themselves up for success. Now let's talk about competition. What's the landscape like for these three? Cutthroat, or do they have a decent market share?
It's a competitive world out there, especially in consumer staples. Lots of big players fighting for shelf space and trying to grab consumer attention. PepsiCo, for example, they're going head-to-head with Coca-Cola in beverages. Plus, they've got competition from all kinds of snack food companies, big and small.
Yeah, the battle for the snack aisle is real. How are they holding up in that fight?
Well, PepsiCo's got that brand recognition, that global distribution network, big advantages, and they're spending a lot on innovation and marketing to stay ahead.
So they're not just letting Coca-Cola walk all over them. What about Hormel? Who are they up against?
Hormel's got those other meat processing giants to worry about, Tyson Foods, Smithfield Foods, plus all the smaller niche players. The packaged food space is crowded, so they need to keep innovating to stay relevant.
Makes sense. And what about Hershey? Any serious challengers in the chocolate world?
Oh, tons. Mars, Nestle, Lindt. So many chocolate companies out there with their own loyal fans. Hershey's has to stay on top of trends and keep their products fresh to hold on to their top spot.
Okay, so no one's got it easy. Constant pressure to improve and innovate.
That's right. You snooze, you lose.
All right, we've covered a lot here. Financials, growth, competition. So what's the verdict? Do you think these fallen angels have a shot at redemption? Can they deliver good returns for investors?
They each have their pros and cons. PepsiCo, they're a global powerhouse with a huge variety of products and a focus on innovation. Hormel, they have a solid history of making money, and they're constantly developing new things. Hershey's, they have that iconic brand and a very loyal customer base.
But they all have those challenges we've been talking about, too.
Exactly. We can't forget about those. But the important thing is these companies aren't just sitting around waiting for something to happen. They're tackling those challenges head on and making plans for growth.
So they're taking action. They're not just hoping for the best.
Exactly. That's a good sign. It means they don't want to stay fallen angels. Can they get back to their former glory? We'll have to see. But they're putting up a fight, that's for sure.
That's a great point. So for investors who are interested in these companies, what should they be paying attention to? What are the key things to watch for in the coming months and years?
I'd say it's all about monitoring their progress in addressing those challenges we talked about. Are they making real headway in cutting costs, getting into new markets, developing innovative products? Are they holding their own against the competition? Are they keeping up with what consumers want and how the economy is changing?
So we're looking for proof, not just promises.
Right. And of course, keep an eye on their financial performance. Is revenue growing? Profit margins stable or getting better? Strong cash flow? Those are the signs of a healthy and sustainable business.
Excellent points. Well, we've certainly done a deep dive into these three companies today. We've explored their good points, their weaknesses, and their potential.
We have, and I think what we've learned today is that it's not enough to just look at stock prices. We need to really understand the businesses behind those stocks and what makes them tick. Investing isn't about luck. It's about careful analysis, thinking things through, and making smart decisions based on what we know.
I totally agree. And while we've focused on these three particular companies, that fallen angel concept is something you can apply across the entire market. You can use it to find potential opportunities in any sector or industry.
That's right. So as you continue your investing journey, remember what we talked about today. Keep your eyes peeled for those companies that have taken a hit but still have what it takes to get back on their feet. Do your research, ask the tough questions, and you might just find some hidden gems in the market's ups and downs.
Great advice. Thanks for joining us for another deep dive. We'll be back soon with more insightful analysis and thought-provoking discussions. Until then, happy investing.